It's hard not to notice the stock market going up and down, but if you are prepared, there's nothing to be scared about. Certified financial planner Kimberly Foss joins us live from Roseville to help us navigate and get prepared. Kimberly, good morning.
Good morning, Richard. How are you?
Good. In the bullet points you sent over, I really like your first bullet point here about being prepared. A stock market is about the money being transferred from impatient people to patient people.
Yeah, this is what Warren Buffett said. You know, the market is just a device to transfer money from impatient to patient, which means that if you're prepared, you're good. But if you're unprepared, think about this tip. Whenever the market goes down, Richard,
yes,
there are two transactions. There's a buyer and a seller. So when people are exiting the stock market, always remember there's somebody on the other side buying as well. And the market will then go up again with time, over time. So that's the most important to think that long term.
Throughout the pandemic, too, we have seen what many people call the wall of worry. Different times when the stock market's going down, we're like, wait. Then it goes up. Talk to us about the longevity of the market. It always, in the end, goes up. And you'd be surprised. People think, oh, it's going to be 5-10 years. No, it's always a lot faster that you can see gains.
Absolutely. The wall of worry is something that goes back to actually 1934, and you can see basically pandemics, currency crisis, wars, credit defaults, you name it, it's been there, impeachments, assassinations. And the question is whether or not, basically, does the market really go up over time? And if you look at that chart, I show that to my clients when they get nervous, it does go up over time. It just may take a little bit more longer in some instances than others. So people shouldn't panic. Look at the data.
Let's also talk about, if you want the risk of doing stocks and the gains here, you can assess your risk and go really risky or less risky. But I like what also you sent over the quote. I think it's from Warren Buffett, too. If you aren't willing to own a stock for 10 years, don't think about owning it for 10 minutes. That's an important lesson to learn.
Yeah, especially in the last couple of years, Richard, with the market being so volatile and there's so much money that has been poured into the market. And then the barriers to entry like Robinhood, so many people can get into the markets with such less amount of money that it causes that impatient or it causes that greed cycle. And that's the thing you need to look. Investments are for the long term. You're either an investor or a speculator. An investor is, you got 5 years. If you can wait in the market for 5 years, you will get your reward over time. The question is, can you be in the market for 5 years? If you can't, Richard, my advice is that you probably shouldn't be in the market at all then.
And that is important, especially as you get older and older and you assess your risk value, how aggressive. The older you get, the less aggressive you can be.
Absolutely.
And the more prepared you can be to weather ups and downs like we're seeing right now.
Absolutely, Richard. Absolutely. And the thing is, if you're older, look at your age.
Yeah.
Take 100 minus your age. That's your exposure to equity. Get an advisor if you can't stay disciplined.
Bingo. Kimberly Foss, always great advice. Kimberly, thanks for holding our hand through this up and down period with the Wall Street. I appreciate it. 7:48 right now. Let's get over to Adam in the Weather Center.